Hey everyone, Ruth Squires here. It's time for our market stats for month ending July 31st, 2022. I'm going to go deeper on this one. I want to talk more about the economy, about interest rates, inventory levels, the overall projection for the real estate market, and how all of these things kind of play together, play into one another, hopefully bring some clarity to what is happening out there and what the expectations are going forward. So stay to the end of this video. I'm going to share a tool that I think is going to be very helpful to have in your back pocket, whether you're buying or selling. It's going to help you navigate and circumvent the impact of rising rates. So stay to the end for that tip. I'm Ruth Squires with eXp Realty, RES Luxury Group, white glove service, red carpet treatment. It's all in the name. We are not the same. We believe everyone deserves a luxury experience. So I'm going to go ahead and share my screen now. I want to talk about the economy and also what's happening with the cycle. What cycle of the market are we in and what does it mean? There's a lot of talk. There's a lot of media out there right now that's talking about some different things that might be a little bit scary. So let's talk through them. First off, we're hearing a lot about, are we in a recession? So the definition of a recession is 2 consecutive quarters of negative GDP. So we know that the first quarter of the year, it was a negative 1.6 GDP. And for the second quarter, we've had the advance announcement from the Economic Bureau, which says that we're at a negative 0.9%. And we still have the first and second announcements that will come out. First announcement will be August 25th, second will be in September. So we won't know for certain until then, but it certainly seems that the writing is on the wall that that's the direction that we're headed. When you look at projections from business owners, 3/4 of global CEOs are stating that they believe we are in or will be in a recession within the next 12 to 18 months. So what does that mean to our housing market? Historically, when we've gone into a recession, mortgage rates rise, and then as we emerge out of the recession, mortgage rates decline again. So that can be good news. We're seeing mortgage rates increasing right now. And as we emerge from the recession, we can expect that we'll see some improvement on rates going forward. So you can see from these charts, we're looking at a number of different recessionary periods where you can see the spike in interest rates and the decline at the end of the recession. Here you can see it in more direct numbers. Of course, in the early 80s, if you were in the real estate markets, you were experiencing those really high 16 to 18% rates. I like to remember those days if you can think back to those days, because now we're dealing with 5-6% rates, and it's very shocking for people because we've been so spoiled with the 2-3% rates, but it could be much worse. So don't forget the early 80s. But the fact that rates will likely come down as we emerge out of a recession is a very positive thing to keep in mind. So over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak to the trough. So again, we would expect to see some rate improvement at the end of the recession. And then of course, even when we've determined that we're no longer in a recession, just like it's a lagging indicator that we are in a recession, we will be done with the recession, but still in a recovery period where interest rates may continue to be improved over that period to help the economy bounce back. So let's talk about real estate inventory. We're going to shift into more of the real estate discussion now. And I said shift, isn't that perfect? Because we're in a shifting market. And what does that mean? So first off, we know we've had low inventory levels. I like to call them depressed inventory levels for a couple of years now. And as we look at what that means to the market, as the inventory levels slowly but surely start to come up, we're seeing fewer offers for each house that's listed. So the competition is starting to soften for buyers that are out there. We're also seeing less and less offers going over asking price. I can tell you we're seeing time on the market steadily increasing right alongside of these things. The rate of sales is going down, right? So all of these things then cause our inventory levels to naturally go up. So it's not that we have more houses coming on the market right now. It's that interest rates are increasing, which is causing buying activity to slow down, which then causes our level of inventory to be able to lift up a bit. We are seeing some more homes, but the majority of the changes because of the impact of the slower buying activity. So all that being said, it's a positive thing if you're in the market to buy. So now when we think about that, what do these projections look like and how does it correlate to what we're experiencing locally? So nationally, we started out with in January with 1.6 months of inventory. We've steadily increased nationally up to 2.6 months of inventory as of May. So for our local market, as of the end of July, we were still under 1.5 months of inventory for Citrus County. So we've got a long way to go, but it is starting to improve. So existing home sales, again, this is nationwide. We go back 5 years. We see that 5 years ago, we were at 5.5 million homes sold for the year. And then when we look at current for May of 2022, the projection is if we keep the current pace, we'll be at 5.4 million homes sold for the year of 2022. So we have come back to more normal levels like we were experiencing before the pandemic hit. This pandemic's kind of tossed everything upside down, made everything feel really crazy, and now we're getting back to a level of more normal. So I think that that's going to be a welcome adjustment. Whether you're selling or buying, you'll be able to take a breath of relief from all of the insanity that we've been dealing with out there. So when we look at the active inventory compared to year over year, nationwide, we have a 21% increase, and locally, we're looking at a 61% inventory increase from this time last year. So we are starting to add more options for buyers, but again, we've got a long ways to go before we see a full improvement on that. All of that means we're going to see less competition, fewer bidding wars, and less upward price pressure, which means buyers won't be faced with as much pressure to mitigate appraisal gaps and things like that we've been seeing in the last year to 2 years. And this particular chart says a simple analysis shows that a 1 month increase in the month's supply results in a 3% decline in annualized house price growth. So let's talk about the moderation that we're seeing in house prices. So this goes more in line with the shift of the market, and what sellers are concerned with is the market going to decline. We are in what's called a decelerating market. It's not a depreciating market, it's a decelerating market. So what that means is prices are not coming down. They are still projected to go up, but the pace of increase or appreciation is slowing down. So the best analogy would be if I jump on the Suncoast Parkway headed to Tampa, and I'm so excited to get to Tampa, my lead foot just starts pushing that pedal hard and I'm going 100 miles per hour. Next thing I know, I see a police officer waiting to stop speeders. And so I push the brakes, slow myself down, slow down to 60. And all of a sudden I feel like I'm barely moving. That's what we're dealing with. We've been going full speed ahead as far as price increases with these homes. And we're now going to push the brakes. Things are going to slow down. We should still see more normal appreciation in prices, just not the insanity that we've seen the last couple of years. So nothing to be afraid of. And when we look at the forecasts, we're taking a number of different economic forecasts here, and we're averaging 8.5% increase for 2022. So not the 20 to 30% that we've seen the last 12 and 24 months, but still a nice appreciation for homeowners in 2022. So of course, supply and demand is what drives the housing prices, and with demand starting to slow down, supply is increasing, and prices thus are going to stabilize more. So this is very interesting. I often am hearing, where are these buyers coming from, right? Because it feels like with the mad, rush to buy homes in the last couple of years, it kind of felt like it didn't seem like the right balance. We know that in our local market, we have a lot of people looking for secondary vacation homes and things like that. But I also think it's interesting to point out that our millennials, our younger generation, aging between 20 to 34 years of age, are going through the first-time home buyer sequence right now. And when you look at this, we're talking about 81% of first-time home buyers are part of this 20 to 35 year age bracket. And of all buyers, that same age bracket makes up 43%. So this is a really huge segment of our market. So one of the things I would say with this is it makes sense to be very aware of what first-time home buyers have available to them. My team, we are experts as far as first-time home buyer programs that can help you if that's who you are. And then if you're selling your home, be receptive to some of the things you might run into with first-time home buyers. These can be very strong buyers, very motivated buyers, and you don't want to, with that level of first-time buying activity, you really want to be open to it when you're selling your house. So really good news, the experts do not see that we are headed for another crash like during 2008. We're still suffering from low inventory levels, a housing shortage. We don't have even enough new construction. We're not at levels that we would expect there. So we need more homes, and we're going to continue to have good demand. So that is going to keep prices going up. So here is the tip. Thank you for pushing through this presentation with me. And the tip that I want to share with you is, with rates going up, it is diluting purchasing power for buyers. So every time interest rates go up, the price point that a buyer is comfortable or eligible for changes. So one tool that can be really helpful is being aware of and receptive to rate buy downs. So a buyer can work with their lender to see what the cost would be to buy their interest rate on their loan down by a point, 2 points, whatever makes the most sense. And when they figure out what that cost is, they can use that as a negotiating tool with a seller. So as a seller, if you're receptive to that, and let's say you were looking at making what I like to call price improvements, where you drop the asking price on your house, you might be able to make a matchup with a buyer by doing a rate buy down, which would end up being a higher net effect to you as a seller and a better loan effect to the buyer. So it's a really interesting thing to keep in mind as a tool. If you're thinking about making a price improvement, I would talk to your agent about the option of doing offering a rate buy down. Do you have any buyers out there that might be a good solution for? And can you go that route before you drop your price significantly? So just a tool to be mindful of. And as always, RES Luxury Group, we're out there looking for ways to really streamline the process for you and make this really a fun and stress-free process, whether you're buying or selling. So if you'd like to talk to any one of us on the team about how we can assist you, please feel free to reach out to us. The number's 352-794-1426. And we hope to talk to you soon. Have a great day.